So the price should get here during London kill zone or as the London session. Okay, so this is when price should get here. So let's see. There we go. Time is good. 11:30. No reaction. Can you see that? No reaction from the zone. So do we enter? No. Okay, we did not get the reaction we need. Then we do not enter. But from here, now time is good. It has done a manipulation of Asia. Now we can sell it. Stop loss above the rejection block. Okay, so you have around 2 point. Yeah, I had around 2.8 pips with spreads. And then we target the Asian low. Okay, we target the Asian low. What happens? There it goes. Right at 12:30. Okay, that is 8 a.m. London time. There we go. Okay, a manipulation of Asia. And then comes the drop. See that? Right into the targets. Now, you can see the consistency, right? It's the same thing. Okay, it's the same thing again and again and again. And for this one, this day we had NFP coming, if I'm not wrong. So my final targets were all the way down here. So I did not pay myself here until it got into these equal lows. So that was with NFP. Look what NFP did. Okay, so yeah, for this, direction matters a lot because how do we know the direction? Major breakout structure. See that? Major breakout structure bearish. So this move to the upside was only a retracement. Okay, so timing is good. Reversal times. Price has gone above Asia. Now it's dropping. Okay, so FOMC, I'm sorry, NFP is about to come. There it comes. Okay, so that's it. That's NFP. Okay, so that's that. Okay, so let me show you. Let me show you some more. Yeah, look at this one. Now you can see how Asia is a pool of liquidity, right?
Yeah.
Equal lows. So are you going to buy it in here? Are you going to call this a strong low and buy it here? No, you'll have to wait for that to get taken out. Okay, so on the H1, what did we have? Rejection block. Okay, rejection block. And what is the next thing you take into consideration? What's that? Timing, right? So this should happen during London kill zone or as London open. Okay, see, like using timing as a confluence is one of the best things you can do. Okay, so look at this. At this is the time window when we expect the trade to happen. Okay, 11:30, 12:30. So a 1 hour time window. This is when the manipulation should happen. So what happens? Okay, there it goes. Now it's 11:30. Timing is good. And there it comes. Taps, a false run in the opposite direction. Trend lines forming. Supply zones forming. Sellers are getting in. What happens? There it goes. You buy it here. You target the Asian highs. Can you see that? Same exact thing. Okay, same exact thing again and again. You understand the setup, right? Hope it's clear. Okay, yeah, same exact thing. Okay, so let's see. Yeah, look at this day. This day, of course, it was a risky one, a very risky one, because like let me show you. Because right above Asia, we had a rejection block in here.
Yeah.
Okay, but the thing is, what happened was, without tapping into that, the 50-minute created a strong high. Okay, now I was a bit skeptical about this trade because there's a 4-hour zone in here, right? How can we trust the 50-minute? Okay, but it's all about taking it. So what I did was we got the stop hunt, breakout structure on the 1 hour time frame. Yeah, the rejection block was here. It was already tapped into. Let's go look into 30-minute. 30-minute rejection block was here. See that? So that could be refined into this, like this, and liquidity below it. So now since London has already played out, the next time I'll be expecting like this is what would happen. The next time when we expect a mitigation into this high is what? When? New York kill zone or New York open. Okay, so London kill zone, London open, a manipulation of this during New York kill zone or New York open. See, now for me, New York kill zone is at 4:30 p.m. Okay, so now I'm selling it. Okay, risky one. Now you know why it is risky, because we had a high time frame zone here. Stop loss goes somewhere around here for 5 pips, and then we can target the Asian low. Why are we targeting the Asian low? You might think it's a strong low. Okay, look at this. Liquidity. See that? Building up. Okay, so what happens? There it goes. New York kill zone. Okay, this liquidity taken out, and then comes the drop. See that? Okay, so targets are what matters. Okay, not entries actually. Your targets, you have to have proper targets, because what if I just take a sell here and then close it somewhere around here? Like I'm losing a lot, right? Like not losing actually. See, I'm losing a major part of the move. So even after that, it ran up to 30 pips. Okay, so that's that.
Do you trade on New York?
I trade New York only if I miss London. So what I normally do is, if I take a loss during London, then I'll trade gold during New York session. Okay, like not mainly GBP USD, because now for GBP USD, the major moves happen during the London session. Okay, the major moves happen during the London session. Only like sometimes New York might give you proper moves, but not all the time. Okay, not all the time. So I prefer trading GBP USD during London, gold during the New York session. Okay, because gold will be crazy during the New York session. I'll show you. Okay, I'll show you because on gold, like I'm still having a lot of runners and stuff. I'll show you all of that later. Okay. So yeah, that's that. Now, can you understand the Asian setup? That's
Yeah, I
fine.
do.
Yeah. Okay, you understand that, right? Okay. So now the next thing is, now let's talk about trading ranges. Okay, let's talk about trading ranges. So now, yeah, if you would have known, you might know that already. So a trading range will always start from a strong high or as a strong low. Okay, it always starts from a strong high or as a strong low. So let's say we had something like this. Yeah, I'll show you. Let's just get fully into the charts after this one. Okay, so let's say we had a strong low like this. Why is this a strong low? Because liquidity taken out, minor break, and then the major break is in here. Okay, yeah, for this example's sake, let's say that this right here was our trading range. Okay, I'll tell you how to confirm the range from here to here. Now, let's say the market started falling down. Okay, so why is it coming down? Okay, why is it coming down? Remember, a pullback is always to take out the internal range liquidity. Okay, it is always to take out the internal range liquidity. So what's the internal range liquidity? The internal range liquidity will be the liquid that is resting within the range. So which means that is the swing lows. Okay, the three candle formation. The swing lows that are inside of the trading range. That is what we call the internal range liquidity. Okay, these swing lows are what we call the internal range liquidity. So it comes down, clears that out, and then it goes back up. But if it is this clean, then anyone will be making money out of the market, right? So like, because thing is, sometimes, yeah, you get this. Sometimes you get this. Sometimes even this, or sometimes this, right? So why does that happen? Why does that happen? Like, how do we know where it's getting into? Okay, no one knows where it is exactly getting into. So what we do is, remember, within a lower time frame trading range, okay, within a lower time frame trading range, we always look for a higher time frame point of interest. Okay, within a lower time frame range, we always look for a higher time frame point of interest. So which means, like, it depends on the time frame you're looking at. Let's say it's a 4-hour range, then you look for POIs from above the 4-hour time frame. So it could come from the daily, weekly, or monthly. If it's a daily range, your POIs can come from the weekly and the monthly. If it's a 1-hour range, okay, it has to come from, it has to always come from above it. Okay, so now let's say this right here was a 4-hour range, and you had something like a maybe daily order block in here. Could happen, right? I'll show you examples. Let's say we had something like this. The market started retracing, got into these zones, and it turns bullish. Okay, let's say something like this happen. Now it's like this. There's always two trends in the market, right? There are always two trends in the market. What is that? The major trend and the counter trend, right? The major trend and the counter trend. How do we know what the major trend is doing? How do we know what the major trend is doing? So in order to know what the major trend is doing, we have to look into the major breakout structure. Remember, always remember, a key thing to note is that, like, breakout is the direction. Okay, breakout is always your direction. So whichever side the major breakout structure happen, that is your direction. Okay, that is your direction. So now in here, what's the major breakout structure we have? This one, right? This is the major breakout structure we have. So this move to the downside is only to clear out the sell stops. Okay, it is only to clear out the sell stops. So remember, a drop in a bullish market is a hunt for sell stops. Okay, a drop in a bullish market is just a hunt for sell stops. So we know the market is bullish. So this move to the downside is only to take out maybe this swing low. Okay, let's put that aside. But just now let's say this thing started coming down, tapped into a daily point of interest, and once again the counter trend turns bullish. Okay, now like I told you, there are two trends in the market. What is that? The major trend and the counter trend. Okay, so now the counter trend has also turned bullish. Can you see it? The counter trend has also turned bullish. Now remember, when the counter trend is meeting up with your major trend, we call it the range expansion. Okay, we call it the range expansion. When both the trends are doing the same thing, we call it the range expansion. Now you're not going to think, oh, there's still some liquidity here, or still some liquidity here, and you're not going to just look for a sell from somewhere around here. No. Why? Because the range expansion has begun, so the next target will be the external range liquidity. Okay, external range liquidity. So remember, always within these lower time frame ranges, you have to look for the higher time frame POIs. Only that way you will know where price might reverse from. Okay, we're not very sure like if it is going to reverse from here or here. So the best thing to do is just have those zones marked out. Okay, the zones of interest. That is why they call them a point of interest. We have them marked out. If it gives you the reaction, then you buy it. Okay, so I'll show you. Like we're only gonna go with the trend itself. Okay, we're not gonna do a lot of counter trend trading because it is risky. We will be going with the trend itself most of the time. Okay, so this is why sometimes you only get these shallow retracements. Can you understand that? Okay,
Yeah.
so like this move could even happen in a premium price of this range. Okay, this could even happen in a premium price of the range. It doesn't have to, like it's those days, like I thought, yeah, it must get into discounted prices, but nah, it doesn't have to get into discounted prices all the time. This could even happen in a premium price and then fly. Okay, so yeah, I'm pretty sure you would have seen stuff like that happen. Okay, so yeah, that's that. And
I
then
have a
how do we
question.
yeah, what's that?
Okay. What, go on and tell me how to confirm the range. Then I ask the question about the
Yeah,
zone.
I'll tell you.
Okay.
Okay. So let's say price started falling down, got into maybe a discounted price and it turns bullish. Now remember, as soon as it turns bullish, okay, as soon as it turns bullish, you can't say this is the low of the next trading range. No, that's wrong. Okay, so it's like in simple terms, a higher low is not confirmed until it creates a new higher high, right? So same thing in here.
Yeah.
This low will only be confirmed as the low of the next trading range once it breaks out of the previous range.
Okay.
Okay, so once you get a break out of the previous range, like this, then we can confirm that, there we go. This is the low of the next trading range. Okay, that will be the low of the next trading range. Okay, the low is confirmed. But how do we know the high is confirmed? The counter trend has to turn bearish. But now what do we know? The major trend is bullish, but the counter trend is bearish. Which means it is not the range expansion, right? If it's not the expansion, it is the corrective move, or else it is the pullback, right? It is the pullback. So yeah, now it might get into some of these areas, and once it turns bullish, now are you going to say, oh, stop on breakout structure, strong high, let's sell this? No. Okay, the major breakout structure is bullish, counter trend is bullish. So now you're not going to look into strong highs, you're going to look into strong lows. Stop on breakout structure, you can expect a retracement and then buy once again. Okay, so this is what we'll be doing. And the next thing is, now you might be wondering, okay, on which time frame should I wait for the break, right? So now it's like this. It depends on the time frame that you're looking at. Now, if this is a 4-hour range, you're not going to go to the 50-minute and then wait for the 50-minute to turn bearish. Okay, no, you might get this formation in here. You might get it here. You might get it here. No, that will leave you confused. Remember, this break has to happen on the same time frame itself. Okay, it has to happen on the same time frame itself, because like I told you, we're not going to wait for these huge structural points to break. We're only waiting for a 3-candle formation to break. Okay, we're just waiting for this 3 candles to break. That is what we're waiting for. A swing low that created a higher high. If that breaks, we have the confirmation of the trading range. Can you understand? So this is how we confirm a range. Okay, this is how we confirm a range. I'll show you examples later. So is that clear? Let me know. Yeah. And what was your question?
That's very clear. So my question is, you talked about the zone, the premium and discount zone. So let's say we have a 4 hours range confirmed already. Okay. And inside a 4-hour range, we have a 1-hour range. Okay. And in that 1-hour range, price, according to the 1-hour range, the price is at discount. But in the 4-hour range, the price is at premium.
Okay.
What do we do in that instance?
Like you mean like when like so on the 4-hour range, price is at a premium, but on the 1 hour it is at a discount, something like that.
Yes, something like that. Yes.
Yeah. So now the main thing to do is now with this breakout structure, okay, with this bearish breakout structure, we know that, okay, now let me show you. With this bearish breakout structure, we know that now the pullback has already begun, right? Of this trading range, the retracement has started. So once we get this break, now we can drop into lower time frames. Let's say on the 1 hour, we can mark out a range like this, top one, breakout structure, strong high. And now look at this. We have a range like this.
Yeah.
Can you understand that? We have a range like this now. So now once again, we can look for sales from the 1 hour range, a premium price of the 1 hour range. Okay, so now the thing is, now let's say this thing also came down. Let's say it started coming down and it turns bullish right here. Let's say the counter trend turns bullish right here. Now are you going to say, oh, a strong high once again, a strong high on the 1 hour, breakout structure, internal range liquid, and are you going to look for sales in here? No. Why? Because Major breakout structure bullish, counter trend bullish. It's going to move out now.
Yeah.
Can you understand that? Okay, so this break right here, these breaks are what matters, not these minor breaks. Okay, not these minor breaks. This right here, this is what matters all the time, all the time. Okay, if you manage to get this one properly, if you manage to look at this one, it's very simple. Okay, I'll show you. If you manage to get, like, look at this break, if you manage to mark out this break properly, you're always in the right side of the direction, because then you will know when the major breakout structure is bullish, the only reason they're coming down is to take out some internal range liquidity. And as soon as this counter trend turns bullish right here, you know that you're not going to look for sells anymore. Instead, with every single pullback, it's going to be an opportunity for you to buy. You buy it here. You buy it here. Okay, instead, you're not going to just look for sells in here. No, because why? This is bullish. This is bullish. You're going to keep on buying it. Keep on buying it. Can you understand that? Okay, hope that answered. Yeah?
Yeah.
Hope that is clear. Okay. Okay, so that's that. Now, I'll show you examples. Okay, I'll show you examples next. And we delete this. So same thing in the opposite way. Okay, so what is this? What's the major breakout structure we have in here? Bearish, right? So the major breakout structure is bearish. So yeah, let me delete this. The major breakout structure we have is bearish. So every single move to the upside is what? It is only to take out internal range liquidity, right? Or internal range liquidity. And once it turns bearish, you know that the major trend is bearish. Counter trend is also bearish. So what is this? Like, it's the range expansion, right? So then you might get this. And as soon as we get the body closing below the previous range's low, then we know that this right here will be the high of the next trading range.
Sorry,
Can you understand?
sorry, I'm
Yeah.
cutting you short here.
Yeah, no problem.
What if we have a weak break on a daily?
Okay.
But
yeah, I'll show you. Okay, now sometimes on the daily, we might only have weak breaks. Okay, we might only have weak breaks. But on the 4-hour, you might have full body closing.
Body close.
Okay, you might have full body closing, and then you might be confused, right? You might be confused. But remember, like, times like that, like, now, if you're just gonna wait for the daily to once again, like, do all the stuff, then you will miss a lot of trades. Okay, now even the 4-hour is a higher time frame, right? So we can just go along with the 4-hour strong highs. Okay, we can just go along with the 4-hour trading range if the daily isn't clear. Okay, like, once we go into the top-down analysis, it will clear a lot of questions for you. Okay, I'll show you around two top-down analysis, so then that way you will understand. Okay, I'll show you, because, like, if one time frame isn't clear, we're not going to panic. We're not going to stay on that time frame. We're going to drop one time frame lower and then go along with that, because anyway, our context will be based on the higher time frame direction. Okay, so we will always, like, most of the time, we will be on the right side of the market. Okay, the only reason we get stopped out is because our stop losses are too big. Okay, other than that, I'm sorry, the stop losses are too tight. Okay, other than that, we will always be on the right side of the market. Okay, because of these breaks. So I'll show you how important the ranges are. Okay, so yeah, that's that. So this will turn into a strong high as soon as you get a body closing below that low. Okay, as soon as you get a body closing below that low, this will be the high of the next range. So how do we know the high has created the low of the range? Once again, the counter trend has to turn bullish. Okay, once the counter trend turns bullish, this will be your range. Okay, this will be your range. So then why are they going up? That is to take out internal range liquidity. But we're not very sure how far up it's going to go. So now, until then, what are we going to do? Until then, what are we going to do? Let's say this was a daily range from here to here. Are you going to wait until it goes all the way up here and then breaks? No, it might take ages, right? So you go to lower time frames, you mark out ranges from here to here, buy it. Buy it. Okay, so we can also buy it. I'll show how you can do that later. So then let's say this thing started going up, did this. Once you get this break, are you going to say, oh, a strong low? This is the low of the range, this is the high of the range, let's buy it here. No, right? You're not going to buy it. Why? Because the major breakout structure is bearish, counter trend is bearish. So instead of buying it, you're going to look for sell setups from here to here. You can mark out lower time frame ranges and then sell it. Okay, with every single move to the upside, you're going to stack up some sells. Okay, you're going to stack up some sell entries. That is what we are going to do. Okay, so this is how we confirm trading ranges. Can you understand? Hope that's clear. Yeah. So now let's get into the charts. Okay, now you can see your questions, a lot of them. Okay, so now look at this. This was very clean. Let's say in here. What did I tell you? What's the first thing we should? Yeah. Now this is not a top-down analysis. I'm only showing. Only going to show you like examples of ranges. Okay. So now what did I tell you? To always focus on the major breakout structure, right? Can you see how they're breaking down? major breaks.